On the morning of the 11th of May, 1866, the heart of London stopped beating. Outside a corner building on Lombard Street, a crowd pressed against locked doors. Word was spreading from clerk to clerk, from omnibus to coffee house, that the unthinkable had happened overnight. The firm inside those doors was not some reckless upstart. For 2 generations, it had been called the banker's banker, the safest name in the safest square mile on earth. By that afternoon, a newspaper would give the day a title that has outlived everyone who lived through it. They called it Black Friday. To understand the fall, you first have to understand how high the house had climbed. The firm began around 1800 and came under the control of Samuel Gurney, of the well-known Quaker banking family from Norwich. Gurney took the reins of the discount business and built something the world had never quite seen. Its trade was simple in description and enormous in scale. It bought and sold bills of exchange at a discount, lending short and turning money over quickly. By the middle of the century, the house was said to be the greatest discounting establishment on the planet, with a turnover that dwarfed its rivals combined. Its reputation was its real capital. When ordinary banks needed cash in a hurry, they came to this corner of Lombard Street. The firm sat one step below the Bank of England itself, a private clearinghouse for the whole money market. Quaker discipline gave it an aura of caution and probity, the very opposite of speculation. For roughly 40 years, the name carried a quiet certainty. If your bill was good, the house would take it. If you were sound, your money was safe. That trust, built slowly over decades, was the most valuable thing the firm owned, and it would prove the easiest thing to destroy. Samuel Gurney died in 1856, and with him went the old discipline. The men who followed grew restless with the modest, steady margins of bill broking. They reached for bigger returns, and they reached in the wrong direction. Money that should have stayed liquid, ready to be repaid on demand, was poured instead into long-term ventures, railways, shipping schemes, plantations, and ambitious projects that could not be turned back into cash quickly. A house built to lend short had quietly started to borrow short and lend long, the oldest and most dangerous mistake in banking. Behind the polished doors, the numbers were turning grim. From around 1860, the firm was bleeding money on its new ventures, with reported losses averaging in the hundreds of thousands of pounds a year, even as the core broking business still turned a profit. Bad debts piled up against borrowers who could not pay. By the time the full reckoning came, the house would be found insolvent by several £1,000,000, a hole carved out of a balance sheet that ran into the tens of millions. None of this was visible from the street. The name still gleamed. The rot was on the inside. Faced with a sinking ship, the partners chose a remarkable course. In July 1865, they turned the private firm into a limited liability company and sold shares to the public. The £15 shares were offered at a premium, snapped up by investors who trusted the old name and knew nothing of the hidden losses. In effect, the burden of the firm's mistakes was passed from the partners onto thousands of ordinary shareholders. The prospectus that drew them in would later become the center of a courtroom storm. For now, the flotation bought time, and bought it with other people's money. Time, it turned out, was the one thing money could not buy. Through early 1866, the wider market grew tense and credit grew tight. The bank rate was climbing. Whispers about the firm's true condition began to circulate among the men who watched the discount houses most closely. By spring, the company faced demands it simply could not meet. Its liabilities ran to roughly £4 million, while its genuinely liquid assets were closer to 1. The arithmetic of a discount house had finally caught up with it. There was no longer enough cash on hand to honor the promise on which the whole business stood. On the 10th of May, 1866, the directors made their last desperate move. They appealed to the Bank of England for help, and the Bank of England said no. Without that backstop, there was nothing left to do. That same day, the firm suspended payments. The house that had stood behind half of London could no longer pay its own debts. The news traveled overnight like fire through dry grass. By the morning of the 11th, crowds were gathering not only at Lombard Street but across the city, every depositor seized by the same cold thought: if this name can fall, no name is safe. The panic did not stay in London. It raced down the new telegraph and railway lines to Liverpool, Manchester, Norwich, Derby, and Bristol, and everywhere it landed the scene repeated itself. Men ran to their banks demanding gold and notes, and the demand alone toppled institutions that might otherwise have survived. The Bank of England's reserves drained at a frightening pace as frightened depositors and struggling banks scrambled for cash. A single failure on one street corner had become a national emergency in a matter of hours. This was the contagion that gives every banking panic its terror. The government acted that very day. To stop the city from running dry, ministers authorized the suspension of the Bank Charter Act of 1844, the law that tied the bank's note issue to its gold. With the rule lifted, the bank could print notes beyond its bullion to meet the crush of demand and lend into the panic rather than withhold. The bank rate was driven up to 10% and held there for 3 months, a punishing level meant to steady the system. The bleeding slowed. But the damage was already vast. More than 200 companies, including other banks, were dragged down in the wreck. When the dust settled, the firm went into liquidation and the questions began. How had a house this trusted hidden a hole this deep? And who should answer for it? Attention turned to the prospectus of 1865, the document that had lured shareholders into buying a wreck. Prosecutors argued that it concealed the firm's true and ruinous condition. The directors were brought before the Central Criminal Court at the Old Bailey, charged in connection with the statements that had drawn the public's money into a business its own managers knew was failing. Presiding was the Lord Chief Justice, Sir Alexander Cockburn, one of the towering legal figures of the age. The case tested where bad judgment ends and crime begins. In his guidance to the jury, Cockburn drew that line in the directors' favor. He held that they were guilty of grave error rather than of criminal intent, that they had been foolish and reckless but had not set out to deceive. The jury followed his lead and acquitted them. No one went to prison for the director's role in the panic itself, a verdict that left many shareholders feeling that ruin had carried no penalty. Yet the deepest legacy of the collapse was not written in a courtroom. A young financial writer named Walter Bagehot watched the chaos and drew a lesson that would outlast everyone involved. In his book Lombard Street, published in 1873, he argued that in a panic the Bank of England must do the very thing it had refused in 1866, lend freely, against good collateral at a high rate of interest. That principle became the doctrine of the lender of last resort, the rule that still guides central banks today. Overend and Gurney died on a single morning, but it taught the modern world how to keep a panic from killing everything around it.